All right, so it seems we did indeed get that next rate cut. So that brings the Fed funds rate down another, 25 basis points, which puts us more in a target range now of roughly, 3.5 to 3.75%. Based on what I'm reading there. I'll double check it to be sure, but I believe that's where we're at now. And essentially, looking at Powell's statements today, and kind of reading between the lines here, basically, it just seems that the Fed, in general, will be, a little bit more hawkish as we head into 2026, and basically, it seems that they're going to start putting the brakes on the rate cuts, right? And obviously, we'll see. But some interesting things that stuck out to me was first off, the Fed is resuming buying treasuries, right? So, i.e., money printer is coming back on. There's that. Next, in terms of the overall agreements on cutting or not, majority of the board was on board for cuts. There were a few dissents, a couple wanted to keep rates where they were. And then, of course, the same guy wants to still cut by half a percentage point. But basically, everybody kind of, voted along similar lines, and nothing really shocking came out of that. Next up, in terms of what this means, I think for just the overall economy as we head into 2026, I think it's pretty clear that even though there is concern about ongoing inflation, there seems to be more of a focus on just making sure the job market remains steady. And of course, after receiving this news, the market obviously went up several hundreds of points, right? Which again just goes back to the point to just own assets, right? Because all this is signaling is that more liquidity is going to start making its way into equities just in general, right? As bonds just gradually begin to just return less and less, right? Obviously, as yields begin to come down. Now, obviously, right, it remains to be seen if that will continue to hold, in my opinion. Because ultimately, what is interesting about the bond market, right, is that in my opinion, they do a great job of seeing through the noise, right? And so, for example, if it turns out that inflation still continues to be stubborn, right, then you won't exactly see 10-year yields, really come down any significant fashion, which of course plays a part in, mortgage rates as well, and keeping those up. So basically, as things stand, in my opinion, nothing major in terms of stuff that, we didn't know already. And yeah, if you're not investing already, I encourage you to do so because the inflation is only going to continue to go up from here. All right, peace.